Welcome, everyone, to Benefits Compliance, the 2021 Mid-Year Check-In. Thank you all so much for joining us. Our moderator for today's call is Carol Wood. She'll be answering the questions you send through the Q&A as opposed to the chat today. We will try our best to answer all of your questions, but if for whatever reason we're unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We will be sharing the recording in the Get Wise Wednesdays emails and on the NFP website. If there are any portions of this call that you have missed, by Friday, you will receive an email with a link to the full recording. The PowerPoint slides used during today's presentation will be shared in that same email. Additionally, for those of you who are certified with your PHR, your SPHR, or your GPHR, this webinar is pre-approved for a 1-hour recertification credit. In the next 24 hours, I will email the program ID number for you to record and submit to the HR Certification Institute. This credit will only be available to those who listen to the actual webinar, not to those listening to the recording later. Additionally, you must have remained on the call for the entirety of the webinar to be eligible for this credit. At this time, I'd like to introduce our speakers for today's webinar. Joining us today are Beth Allen, Vice President and Counsel, and Diane Cross, Vice President and Counsel for NFP's Benefits Compliance Department. We're very excited to have them speaking with us today, and it is my great pleasure to hand the call over to our speakers. Diane, the floor is yours.
Well, thanks, Leanne, and welcome everyone to our presentation today, our 2021 Benefits Compliance Mid-Year Check-In. For me, it's hard to believe we're already mid-June, but here we are, so let's embrace it. And so we wanted to take this next hour to discuss where we're at midway through 2021, hence our check-in. And I don't think it's any secret that last year was a pretty tough year for a lot of reasons. And of course, benefits compliance was no exception. And the beginning of 2021 also included some, shall we say, goodies, right? So with that in mind, we're going to be focusing today on some practical implications of timely benefits compliance matters, and we'll discuss a bit about what to expect going forward. So that being said, you have myself and Beth Allen with Carol Wood moderating our call today. And let's do some disclaiming. We have our usual disclaimer noting that the following information that we'll be sharing is used for general guidance purpose only. It's not intended as tax advice or legal advice, and any questions of the application of what we share should be addressed to legal or tax counsel. And of course, this information is current as of today. So what do I mean when we're going to talk about some certain timely compliance matters and what to expect going forward? On our agenda today, we have an ACA status. What I wanted to put up there was an ACA status update, but as you can see, we have a non-update update, and we'll talk about that momentarily. The extension of certain timeframes, ARPA, can't talk about where we're at mid-2021 without discussing ARPA, and what we're going to focus on today is the little overview of the premium subsidies provided for Cobra and tax credits for the extended paid leave. And we'll also be talking more about CAA and where we're at with certain relief, mental health parity and QTL comparative analysis requirement, and some transparency and coverage topics. We'll also give retirement some love. So we'll talk a little bit about Secure Act 2.0 and some housekeeping items regarding upcoming deadlines, or as we like to title this section, business as usual. So for each of these topics, what you will notice the trend is we're going to give a little overview on the topic, what's next or what's on the horizon or what we should be thinking about and practical implications for plan sponsors. So without further ado, we're going to get straight to it with the ACA status update or non-update, unfortunately. So here we are still waiting. I'll skip to the practical implications. We are still in a wait and see and waiting to see what the outcome of the Supreme Court case is, or the Supreme Court decision is. So as a brief overview of where we're at regarding ACAs, as you may recall back in 2012, there was a court case that challenged whether or not the individual mandate was unconstitutional, and the court ruled that no, in fact, the individual mandate is a permissible Congress's authority to tax. So it is permitted due to Congress's authority to tax, but then in 2017, there was some action that reduced that penalty to zero. And so Texas, along with several others, filed suit saying, okay, it's now unconstitutional because it's no longer a tax. And the court actually ruled that the individual mandate was unconstitutional, but perhaps it could be severed from the ACA. And there was an appeal to the Supreme Court. The Supreme Court heard oral arguments last November. And since then, we've been waiting with bated breath on the Supreme Court decision. So as I mentioned at the beginning, is that we're in a wait and see pattern. The current status of ACA provisions is that the insurance mandates and market reforms are still in effect. The employer mandate and reporting requirements are still in effect, although the individual mandate penalty is zeroed out. There are other taxes related to the ACA that you may have forgotten about, as this Cadillac tax has since been repealed, HIT has been phased out, but PCOR has been reinstituted through 2029. So for now, we're in a wait and see. And I will say, this is on a day-by-day basis, and we could have different information as soon as tomorrow. So please note that if that is the case, or when that is the case, and when we hear from the Supreme Court, we will certainly be communicating updates accordingly. So with that, that is our ACA status update or non-update, if you will. I will kick it over to Beth to talk a little bit about where we are at with extensions of certain timeframes.
Thank you, Diane. And before I jump into extensions of certain timeframes, just on that ACA case, like y'all are used to us at this point, especially if you've been with us for a number of years. You're used to us telling you basically that nothing changes until it actually changes, right? So with the ACA, no matter what happens, if the Supreme Court comes out with a decision tomorrow, if they blow up the entire ACA, you'll still want to look for some kind of indication from people like ourselves in compliance telling you, okay, now your compliance obligations have changed, right? And until then, you're just going to keep on going, as if nothing has happened. And so just kind of keep that in mind, that even as you hear things and articles go out, in the media, that you don't necessarily assume that that means that there's any change in employer obligations right then. Okay. And so now I'm going to jump to extensions of certain timeframes. And I will say, today's going to feel a little bit of, kind of going from one thing to the next just randomly. But these are the things that we just want to make sure that you are still thinking about at this point in 2021. And so if you remember back last year, it seems like it was like 5 years ago, but it wasn't. It was 12 months ago or so. The agencies put out this requirement that basically says that for certain purposes, under rules under Cobra, HIPAA special enrollment rights, and some of the ERISA rules on claims filing and appeals and external review, the plans have to basically disregard this period that is known as the outbreak period. Okay, and so that is the period that started in March 1st of 2020 and will go until 60 days following the national emergency. And for those purposes, that time period in there is actually told. And so it's almost as if it doesn't exist. And the deadlines that are going to apply to certain people, depending on what kind of, provision that they're going to be subject to, would be extended. Okay, now a lot of you are like, yeah, we've been dealing with this for a long time. Why are we talking about this, Beth? Because as you all know, back in February of this year, the DOL basically clarified that kind of the 1-year relief that is available under the statute they use to come out with this particular relief is provided on an individual basis. And so we obviously had conversations about that when it came out. I think we kind of talked about that in a presentation or maybe even two. But the point here is that this is still ongoing. we still don't have an end to the national emergency. Now, kind of given the fact that, like, I think some of the language from the Biden administration is that, like, July 4th, they're going to kind of celebrate independence from the vaccine, or not the vaccine, independence from the virus. And so, does it seem likely that the national emergency will end sometime this year? That is possible, especially if the numbers of people with COVID keep decreasing, and as the numbers of those that are vaccinated increases, we might actually see an end to the national emergency. But we haven't seen it yet. And even when it does officially end, that tolling period still goes until 60 days after the national emergency ends. And so this is one of those things where employers should still be recognizing the fact that participants can actually access this relief. I think that it's been somewhat in the forefront of our thoughts a little bit with kind of the way it works in conjunction with Cobra. But some of the other elements of it, I think employers are not necessarily recognizing. And so, for example, every now and then we'll get a question from an employer that says something along the lines of, oh, we had an employee who had a baby 45 days ago, and he or she was supposed to tell us 30 days after the baby was born, right? Up to 30 days after the baby was born. Now, mind you, in normal years, that is a legit question. And if they notify the plan outside of the amount of time that the plan gives them to notify the plan, then technically they wouldn't have a qualifying event to be able to enroll that person. However, these extensions of certain timeframes are still in place. And so if you have employees who experience HIPAA special enrollment rights, it could be that they are coming to you up to a year later to ask you to enroll them on the plan, and they would have that right to do so. Okay, so you want to keep that in mind, that is still in place right now. And then, like I already mentioned, even after the national emergency end, we're still looking at 60 days after that this guidance would be in place. Now, as I mentioned, for ARPA Cobra reasons, we do have guidance from the IRS and the DOL that kind of makes it clear how these two reliefs apply to each other, and the fact that the extension of certain timeframes does not increase the amount of time that someone has to elect Cobra and receive premium assistance. But that's something that you have to consider. One final way that we've seen this come up is with FSA runout periods. FSA runout periods are basically the time after the end of the year that you have to actually submit claims that you had during the plan year. And so, for example, generally that's just a 2.5-month period after the plan is over. And so usually that will have ended, let's say, after February. However, with this guidance, you actually get the rest of, that year to basically have that relief. And so you're going to have some people who had, let's say, FSA claims in 2020 that they can still come to you now and get addressed as if they were 2020 claims. And so keep in mind that this is still ongoing, and we just want you to remember that. All right, Diane, I think I'm kicking it over to you.
All right. Thank you, Beth. And so with that, we are going to dive into ARPA Cobra Premium Assistance. So since we are in the midst of administering the ARPA Cobra Premium Assistance available, it's only fitting that we continue the conversation during our 2021 check-in. This conversation certainly is not over. In fact, it's probably still going real strong. So as you all are likely well aware, and if you're not, we're going to review some basic concepts regarding the premium assistance. But the American Rescue Plan Act of 2021, as we refer to and the industry refers to as ARPA, provides Cobra premium assistance for assistance eligible individuals, those AEIs. And as an overview, these assistance eligible individuals have to be notified of their right to elect Cobra from April 1 to September 30 of 2021, and they can receive a premium assistance equal to 100% of their Cobra premiums paid. In addition, and this is a high-level overview, and we're going to get in the weeds a little bit in these coming slides, but premium payees, and we'll discuss that further, can claim tax credit for the premiums paid on behalf of AEIs. So what are we doing now, or what's next? Currently, as you may know, AEIs have 60 days to return forms noting whether or not they are assistance eligible to receive the premium assistance. And ongoing notices are provided for new AEIs. So those folks experiencing qualifying events that would make them eligible for premium assistance. There's also a responsibility to provide the expiration of premium assistance notice. And in addition, while this is all going on, premium payees will be claiming their tax credit. We're going to talk all about this through the next half a dozen or so slides. So what is the high-level practical implications? Here, employers might need to re-examine their initial designation of AEIs based on IRS guidance that has come out since ARPA, and we'll discuss that. And then this isn't, as I mentioned, this is an ongoing process, an ongoing conversation until premium assistance ends. So this definitely isn't a check it and forget it concept. This is something that we will need to pay attention to until premium assistance ends. So let's get into it a little bit on, as we set up our conversation today with the overview, the what's next, and the practical implications. Let's dive a little deeper, since COBRA is such a significant topic right now, on an overview. So who are the assistance eligible individuals? And that would be somebody who experiences an initial triggering event, or what we mean by that is their reason for loss of coverage needs to be involuntary termination of employment or reduction of hours. Now, with reduction of hours, this includes both involuntary and voluntary reduction of hours, and would include things like a leave of absence, furlough, a reduction of hours from a change of full-time to part-time. So in addition to that involuntary termination of employment and reduction of hours, the individual needs to still be within their maximum coverage period. And that includes folks who are in their maximum coverage period due to an extension, due to disability, or a secondary qualifying event, as long as the original qualifying event was the involuntary termination of employment or reduction of hours. In addition, assistance eligible individuals can receive premium assistance as long as they are not eligible for other group health plan coverage. And we received some clarifying guidance on that issue, and that means they must be able to enroll in other group health plan coverage. So for an individual who was eligible during an open enrollment, but currently is not eligible again until the next open enrollment, they would be eligible for premium assistance, assuming they are not eligible for Medicare. So an example that's provided is an individual was involuntarily terminated, let's say in October 2020. In November, the individual had a chance to enroll in their spouse's plan, but they didn't. Open enrollment for that spouse's plan ended in December 2020, and the individual has not had another chance to enroll in the spouse's group health plan at any time on or after April 1, 2021. The result here is that the individual is not considered eligible for other coverage until open enrollment for the spouse's plan. So the individual can receive COBRA premium assistance. However, if the spouse's plan has another enrollment opportunity between April and September, they would cease being premium assistance eligible. Okay. I was about to say next slide, and I realized I'm responsible for that. So here we are with notice requirements, as we mentioned in the overview. There are several different notices that we have specific to the ARPA premium assistance. Here's a summary chart on who receives which notice, and you'll notice in big black lettering the due dates associated with these notices. So assistance eligible individuals that were currently enrolled in COBRA, they should have received the model notice in connection with the extended election period and should have received that by May 31st, 2021. In addition, those AEIs not currently enrolled in COBRA, but still in their maximum coverage period, should have received that same notice with that same deadline. Now, qualified beneficiaries who have this qualifying event between April 1 and September 30 of this year, they need to receive the model general notice and COBRA continuation coverage election notice. And that's on an ongoing basis as those events occur while the premium assistance is applicable. And then the Cobra qualified beneficiaries enrolled in continuation coverage through state continuation, there's a model alternative notice available. And that was also due May 31st of this year. And in addition to all those notices, the summary of Cobra premium assistance provisions under ARPA should accompany these model notices, and it gives a little bit more background information for the participant. So there's our notices that we should be dealing with on an ongoing basis, depending on the qualifying events that are occurring and the individual situations. Now, what does the premium assistance look like? This allows AEIs without disqualifying coverage the right to receive Cobra without paying. They're considered paid in full, if you will. Now, it equals the amount the Cobra beneficiary would have paid for coverage absent the ARPA premium assistance. So keep in mind, guidance that we received a few weeks ago clarified that employer subsidy amounts generally are not included. So to say it another way, the amount of the credit is the premium that would have been charged to the individual in the absence of premium assistance, and it doesn't include any amount of the subsidy that the employer would have otherwise provided. I think this is better understood in an example, and it's important that we understand this because it will directly impact the tax credits available to the premium payee. But let's take the example of where an applicable Cobra premium is $1,000 a month, and the employer provides severance benefits that allows individuals to pay the same monthly premium as active employees. So let's say $200 for 3 months. And then after the 3 months, the qualified beneficiaries pay $1,000. And let's say the AEI terminates in March. Here, the result would be that the Cobra premium assistance for the first 3 months, April, May, and June, would only be $200, even though the premium is $1,000. It's because that is what would be charged to the AEI absent the premium assistance. And then the premium assistance would go up July, August, and September to $1,000. Now, premium assistance can only be provided for qualified beneficiaries. And so what that means is the amount of the Cobra premium paid for non-qualified beneficiaries is subtracted from the premium assistance and still owed by the AEI. Simply put, a Cobra qualified beneficiary is somebody who was enrolled in the group health plan on the day before the qualifying event. And we, as you may know, normal Cobra rules will allow a qualified beneficiary to add dependents and coverage during open enrollment or due to HIPAA special enrollment right. And if you are not deemed a qualified beneficiary, premiums associated are not eligible for premium assistance. And then keep in mind that the premium assistance stops at September 30 or when the AEI becomes eligible for disqualifying coverage, whichever would come first. And the tax credit process is that the entity responsible for paying the premium, who we refer to as the premium payee, is entitled to the credit. That's the carrier for fully insured plan that is not subject to federal Cobra. So who are we looking at here? Carriers for fully insured plans who are only eligible for state continuation, the employer for all self-insured plans and fully insured plans subject to federal Cobra, and it would be the plan for a multi-employer plan. And we'll dive into a little deeper on the next slide, but the premium payees file forms 941 quarterly, and that would report the credit and indicate the number of AEIs who received premium assistance. Bottom line here with the tax credit process is it's just that, a tax process. So we would recommend that a tax advisor is the best resource for navigating this process. But as an overview, the credit is calculated each quarter an amount equal to the premiums not paid by those AEIs. And the credit is limited to the amount of the Medicare tax. And the amount of the credit, as we discussed before, equals the amount of premiums plus administrative fees. And that could be up to the 102% of the cost of premium. There's no further guidance right now on what those administrative fees look like outside from the usual 2%. And then if the employer pays more in Cobra premiums than it owes on employment taxes, it can request an advanced payment or that the IRS refunds the difference. So moving on to going in depth on that overview of the Cobra premium assistance, what's next? Right now we're in it. We're in the thick of it, but keep in mind that assistance eligible individuals likely have begun to return forms and will be able to do so for a bit of time now. And it's based on when the notices went out, but they do have 60 days to return the forms. And keep in mind that this is retroactive application. It can go back to April 1. Individuals who become AEIs between now and September are also due an offer of premium assistance. So as qualifying events are occurring, you're going to want to pay special attention to the reduction of hours situation and other situations when there's a loss of coverage. So again, not to keep repeating myself, but this isn't a check it or do it and forget it task. It's ongoing through September 30th, and qualifying events should be evaluated to determine if offer of premium assistance is still appropriate. And then, as we mentioned, the notice of premium assistance or the notice of expiration of premium assistance must be provided within 15 to 45 days before the expiration of Cobra premium assistance. So that is an obligation that employer plan sponsors should be mindful of. And coming up quite rapidly, as we are now mid-June, is that premium payees' first quarterly tax filing is due July 31st. And that's the first quarterly filing for which employers or premium payees could claim the tax credit. All right, so what are the practical implications moving along? As we mentioned as a high-level overview, many employers and vendors sent out notices before we received IRS guidance. And so those entities might want to issue additional notices if they made certain assumptions that are contrary to guidance. So, for example, IRS Notice 2021-31 helps further define involuntary termination, and that definition was a severance from employment due to the independent exercise of the unilateral authority of the employer to terminate employment, where the employee was willing and able to continue performing services. If decisions were made that are contrary to what that guidance provides, the employer might want to reconsider and identify if additional notices are applicable. And in addition, and these are just two examples of the guidance that we received since ARPA was issued, the IRS Notice 2021-31 also says that a decision not to renew an employee's employment contract, so let's think of those temporary employment contract situations, is an involuntary termination when the employee is willing and able to continue the relationship. But it provides a specific example that if the parties always understood that the contract expired at a certain time frame, that it would not be an involuntary termination. I say all this really just to hammer home the point that employers might need to reevaluate their involuntary termination determinations. In addition, employers need to continue to provide vendors with information on involuntary termination employees and those experiencing a reduction of hours. Right now, September 30, 2021 is the date that this relief ends. So what we know at this point is that the relief continues at least through that date. Now, we have been asked, how do we correct mistakes? While we have here legal counsel recommended, but at least stop the bleeding. What do we mean by that? So if you realize a failure to send a notice, you should certainly send the notice. So stop that bleeding and consult counsel with any other actions that might be necessary. So that's where we're at with the practical implications, where we're at in the thick of it, and an overview of the ARPA subsidies or premium assistance.
Now,
So moving
Diane,
along.
all right, just really quickly, one thing I want to clarify, we did get a question in the Q&A box about the concept of the employer only receiving the credit for the amount that the Cobra qualified beneficiary would have had to pay. Because I think we got a question or two that kind of was like, okay, wait a minute, are you talking about the distinction between the employer contribution and the employee contribution? And we're not. Remember that with a Cobra participant, they can pay up to 102% of the cost of coverage. The guidance there from the IRS was basically that if you had Cobra qualified beneficiaries who were going to pay less than that 102%, say because the employer said that on severance, I will pay a certain percentage, then the IRS basically said, well, employer, you will continue to pay that percentage, and the credit will only be for what the person would have paid absent the ARPA subsidies. So sorry, go ahead.
Oh, yeah, that's a great clarification. Anything else we should discuss?
That's it for now.
Okay, so moving along to tax credits for extended paid leave. I feel as though Cobra Premium Assistance takes up a large part of the conversation when folks reference ARPA, but let's not forget that ARPA also extended paid leave opportunities. So as a brief overview, FFCRA required employers with fewer than 500 employees to provide those with up to 10 days of paid emergency sick leave and 12 weeks of extended FMLA or the EFMLA to be used for any number of specific reasons related to the COVID pandemic. And that was through December 31st of 2020. The emergency paid sick leave and the extended FMLA became optional until March 31st, 2021 under the CAA, the Consolidated Appropriations Act. ARPA extended it again through September 30, 2021, and employers who took advantage or chose to permit this can claim a tax credit for the leave provided. So we wanted to bring it up. It's appropriate for the check-in because employers who chose to permit the extended paid leave are eligible to claim a tax credit. What's next is that would be included on the quarterly tax filing on Form 941. And then now keep in mind that employers can benefit more quickly from the credits by reducing their federal employment tax deposits in the amount of the credit owed. And then if there are insufficient funds to cover the amount of credit, an employer can request an advance payment of the credits from the IRS. So keep in mind, though, that this also is a tax issue and a tax advisor is best to provide guidance on this. But the practical implications here are that while many employers have not chosen to provide this leave, you can still change your mind. It's permitted through the end of September of 2021. And recently, I think last Friday, the IRS produced some FAQs and several FAQs, I think over 100 FAQs that cover all aspects of obtaining this tax credit related to the extended paid leave permitted by ARPA. And we linked the resource there. Also want to just hone in as a cursory overview on that is that most of the FAQs are going to detail how to calculate the credit, which forms to use, how to file them, but all of those things that our tax advisor can assist with. And let's not forget state laws regarding leave. Make sure any state requirements that pertain to paid leave related to COVID-19 are followed. So a quick example here, but we would recommend working with HR professionals on this, is Massachusetts recently signed into law mandating COVID-19 emergency paid sick leave for Massachusetts residents. So that's something to not forget, that state law could be in play here. And moving right along to other provisions under the CAA, that are impacting our 2021 benefits administration. We have FSA, Dcap, and Section 125 relief. So as you might recall, the Consolidated Appropriations Act allowed for optional relief for health FSAs, dependent care FSAs, and certain qualifying events. ARPA also allowed extending the Dcap exclusion in elections to up to $10,500. And we have referenced the link to the guidance that helps explain all this. So where are we at now? I want to hone in on the key word that we just explained, that this is optional relief if the employer elected to provide it. And there's no indication right now that this relief will be extended beyond, the plan years which it currently applies. So what does this mean? What are the practical implications? Employers should be communicating these provisions to employees if they chose to implement the optional relief. And really what I wanted to hammer home here is that if an employer did choose to permit this optional relief, that plan document amendments should occur, and that needs to happen by the end of the plan year following the change. So employers, what are other things to think about? Employers offering HSAs should consider how the impact of FSA rollover or grace periods would impact HSAs. And similar to that topic, we received some somewhat recent guidance several weeks ago explaining that amounts from a carryover and a grace period specific to dependent care FSAs are disregarded for purposes of the application of the limit that is allowed to be excluded in the subsequent tax years. Again, I think this is better understood in an example. And a shameless plug for our FAQs on ARPA. Our question number 27 addresses this, and it addresses the situation that if an employer chooses to increase the Dcap contribution limit to $10,500 and also permits a carryover or a grace period from the 2020 plan year, are amounts used over $10,500 in the 2021 calendar year subject to taxation. So what's that? That's the situation. That's putting all this relief kind of into one bucket. So employers are able, the excludable amount for 2021 only is increased to $10,500 for Dcaps. This also means that plans could choose to, they don't have to, increase the contribution amount to $10,500, normally $5,000. But there's also relief, and we're going to go over some of this in the next slide, that allows for extended carryovers and grace period amounts, or extended carryover amounts and extended grace periods that could feasibly have the amounts over $10,500 be used in the calendar year. So our FAQ explains it a lot nicer than I am doing right now. But it goes into depth on that. No, the answer to that question is that ARPA temporarily increases the excludable amount to $10,500 for calendar year 2021 only, but amounts carried over from the prior plan year are disregarded for purposes of the 2021 taxable year limit. So if you have amounts carried over from 2020 to the 2021 plan, those amounts are disregarded for the purposes of the excludable limit. So that was kind of nice clarifying guidance there. Another thing to keep in mind is that Dcap election changes will likely be allowed as children return to school. So again, the one big takeaway there that we wanted to remind is that if employers chose to implement the optional relief, that plan documents should be amended. If they choose to still implement it, which you can, communication should be appropriately made to employees. And that being said, here's a nice overview of the FSA, dependent care FSA, and Section 125 relief that can be implemented if chosen by employer plan sponsors. So you have that extended carryover and the extended grace period that I was referring to. FSAs and Dcaps are permitted to carry over any unused funds, and that's applicable to plan years ending in 2020 and 2021 only. And Dcap sponsors are temporarily permitted to adopt a carryover feature. Generally speaking, a carryover feature is limited to FSAs, capped at 550. You have the extended grace period that can go up to 12 months after the end of the plan year instead of the normal 2.5 months, and that's also applicable to plan years ending in 2020 or 2021. And you have mid-year election changes that are permitted without a qualifying event. As you may know, qualifying events were generally required to make prospective mid-year election changes, and there were really only a handful permitted for health FSA purposes. There's also FSA relief for terminated and furloughed employees, in that those who cease participating in the FSA can continue to receive reimbursement for unused benefits through the end of the plan year that participation ceased. So a spend down provision of sorts. It's only applicable for 2020 and 2021. And then in addition, there's some Dcap relief where expenses for an employee's child that can continue to be eligible for reimbursement when that child turns age 14. So it's only applicable for the regular enrollment period for the Dcap plan year that ended on or before January 31, 2020. So all that said, I'm going to hand it over to Beth to talk a little bit more about CAA. So we're really heavy in on CAA and how it's impacting our benefits administration, and she'll talk a little more about mental health parity and the NQTL comparative analysis requirement.
Thank you, Diane. And as I kind of said, we're jumping around to a bunch of random stuff that seems random, but it's all things that are going on right now. And so the next one has to do with mental health parity. And I'm just going to say, this overview, next slide, Diane, is very short because I could take this whole presentation talking about mental health parity. In fact, we did that back in May when we had the Get Wise Wednesday on mental health parity, and an hour was not enough then. Okay, so I'm not going to go into all the details of mental health parity. You can look back at our May Get Wise Wednesdays for that. But the requirement here that we got from the CAA is for plans that have non-quantitative treatment limitations to basically provide a report to the DOL or other government entities, as well as to participants who ask for the report that outlines the design of the NQTLs and how, or the processes behind how they were applied and are applied in parity. And so that report, interestingly, was required in February of this year, but nobody had one at that point. And as far as kind of what's next, we just now have the insurers getting into kind of creating these documents. We know that on the fully insured side, a lot of the insurers have taken it upon themselves to go ahead and create such a CAA analysis for plans. On self-funded plans, insurers acting as TPAs are a little bit more hesitant to provide the full out analysis, but that is still where a self-funded plan sponsor would likely need to start in trying to do that analysis. We know that some self-funded plan sponsors are maybe trying to work with attorneys or actuaries to kind of do this review for the report. But it's really going to be kind of the insurer or whatever entity it is that actually put the NQTLs in the document that are going to be required to kind of, or would be necessary to provide that information to plan sponsors. And then as far as kind of what this is going to look like from the regulatory side, the DOL is supposed to require some kind of guidance on it by 18 months after the CAA. So that's like getting 6 months into 2022, I guess, is the earliest that they would have to provide it. And obviously, as I already mentioned, the report was already due and somebody can already ask you for it now. So I don't know how helpful that's going to be to employers once it comes. But as far as practical implications, employers really should just be having this discussion with their insurer or their ASO if they're self-funded. And then self-funded plan sponsors specifically are going to have to work with their TPA and those service providers to actually get this done. It's interesting because we generally look at the DOL or the IRS as one of the government entities that is going to come and hold an employer's feet to the fire on most issues. With mental health parity, I actually think that a lot of employers are going to get this request for this analysis from, let's say, parents of children, let's say, with autism or with other individuals under the plan who have a mental health service denied because of an NQTL. Like, I actually think that's where you're going to get the requirement, the requests for this. And so keep in mind that that is going to be one of those things. And just to review, an NQTL is a non-quantitative treatment limitation. That is basically a limitation in the plan that says, okay, we're going to, for mental health purposes, you're going to have to kind of jump through this additional hurdle to receive treatment. And so it's not, let's say, a higher cost as much as it is an additional requirement like pre-authorization for mental health, where you don't require pre-authorization for certain outpatient medical surgical benefits. And so that is what this report is focused on. And the DOL has been looking at this now for a few years. And so this is not new, and it's going to be something that's going to be an ongoing requirement as well. Go ahead, Diane. Oh, and this is kind of just some resources on that, because that was the best thing I felt like we could give you. And again, we provided these in the May Get Wise Wednesday as well.
Thanks, Beth. All right, so carrying on with the CAA, and we've talked about so much about what information the CAAs provide that has impacted benefits administration, that we can't forget about some of the extra goodies that it also provides outside of what we've already discussed regarding transparency. Now, I will provide a little disclaimer here in that for purposes of our conversation today, we're providing a high-level overview of transparency and coverage. And I will also say that the requirements that we are about to discuss are in addition to the final regulations that you may recall that were issued in late 2020 on transparency and coverage. So the CAA includes several provisions designed to improve transparency. For example, the gag clause prohibition, pharmacy benefit disclosures, an advanced explanation of benefits, and certain other requirements, the price comparison guidance, public website directories of in-network providers, certain notice requirements, and other provisions regarding transparency. So I'm not kidding around when I say there's a lot of extra goodies here. There's a lot to unpack. But what we want to, for purposes of our conversation today, want to keep these topics on folks' radar because the majority of these requirements are effective as of January 1, 2020. So for example, I'll go in depth on a few of these requirements, but for the sake of time, again, this is a high-level overview. You have the advanced explanation of benefits, and that is effective for plan years beginning on or after January 1, 2022. And this is if requested for scheduled services. So what the CAA says is that upon request, plans have to send participants an advanced explanation of benefits before scheduled care. And in most cases, this advanced explanation of benefits is due at least 3 business days before the service is to be rendered. And then the CAA does go in to explain the content of what the explanation of business of benefits must include. So, for example, whether or not the provider's in-network, a good faith estimate of the costs, the amount the plan is responsible for paying, and such. Another nuance or another requirement effective January 1, 2022 is that price comparison tool. A plan must offer a price comparison guidance and also make available via phone and website a tool that allows plan enrollees to compare the amount of cost sharing that an individual is responsible for paying regarding specific items or certain services. Now, TPAs and carriers likely have tools to assist, may need tweaking to be compliant with a specific requirement, but it's very likely that tools are already in place to assist. And then another requirement effective for plan years beginning on or after January 1, 2022 would be provider directories. Plans have to ensure that in-network directories are up to date and that participants can access the directory online. So what are the takeaways here is that, first and foremost, we do anticipate additional agency guidance. And once that is received, we will certainly communicate it accordingly. But employers need to be aware that these requirements are coming up and ensure compliance with the requirements for some beginning January 1, 2022. And probably, the logical next step would be to discuss with carrier if that hasn't been done so already, or the TPA as to how they are preparing to be compliant with these requirements. Okay, that being said, I'm going to hand it over to Beth to take us home and talk about the Secure Act and some housekeeping reminders.
Thank you, Diane. And so most of you who are on this call every month of the year know that we focus primarily on health and welfare. But when we have these calls where we talk about what's going on, I like to at least consider what's going on in the retirement realm. I will say that I feel like since COVID started, retirement has been maybe a little bit more quiet. We got a few things out of, let's say, the CARES Act that pertain to retirement, but definitely not as much as you've been dealing with on the health and welfare side. And so I do, though, want to bring up Secure Act 2.0 because some of you will remember that back in 2019, at the end of the year, we got the Secure Act, and it really was the most comprehensive changes to retirement plans that we've had in probably almost 15 years. And so, it's kind of interesting because that was passed with very bipartisan support at a time that was super partisan. And we're already at the point now where there are additional changes that they would like to make in what they even changed under the Secure Act. And so we already know that there's bipartisan support for Secure Act 2.0. It actually recently passed the House Ways and Means Committee unanimously. And so then it would be headed potentially to the full House and potentially the full Senate. We don't have an idea as to when that would happen, but there are certain things that, when there's bipartisan support, we might see it go through sooner than later. I'll also point out here that, we've seen where some states and local governments have started to enter the retirement space simply because everybody is concerned with, people having access to retirement plans and having the means by which to potentially save enough for retirement, right? Everybody acknowledges the problem that we have a lot of individuals that are not able to adequately save for retirement, and everybody is trying to kind of do something about that. And as it pertains to state and local government requirements on that, we've also seen some litigation, for example, concerning the Cal Savers program, which basically says that if you're an employer that doesn't have a retirement plan, then you basically have to allow your employees to put funds into the state retirement program called Cal Savers. And so that's something where we might continue to see a little bit more action. But also, I gather that if we get some movement on some of the things that the Secure Act provided, we may see the states be maybe a little less active on it. But just keep in mind that that's going on. And then obviously, employers are currently beginning compliance with the first Secure Act. I put it there that it's kind of like 1.0, I guess. And Secure Act 2.0 would really just, again, provide additional incentives for employers to adopt these plans using tax credits and things like that, and also have some mechanisms that would allow for people to essentially save more money for retirement. And so just briefly to kind of go through and mention, next slide, Diane, what was in the first Secure Act, and I've listed it here, and I'm not going to talk about all of these because, again, a lot of you will have already worked with your, retirement plan advisors to adopt some of these changes. And some of you who are on this call normally because you hear from us on health and welfare plans might not have a retirement plan and might actually explore some of the options here that are meant to make more retirement plans available to employees. And so we have things like open multiple employer plans, which is kind of something that I think the industry at large was looking forward to. Increased credits for small employers who start plans. The 401k eligibility for long-term part-time workers was a new aspect of the Secure Act. And then as it pertains to things that affect individuals, we saw penalty-free withdrawals for qualified births and adoptions, which some of your employees might have already tried to access, to be honest. And then also the idea that the required minimum distribution age was increased to 72 years old. Next slide. And so then going forward to Secure Act 2.0 and what was in it. Again, a number of enhancements to plans that are going to make it easier for smaller employers and maybe different type of employers to change their retirement plan to the point where more people can participate. We also see that they're actually updating some of the things that they already updated in Secure Act 1.0. And so, for example, I just mentioned that they raised the requirement minimum distribution age to 72 from 70 and a half. And Secure Act 2.0 includes the idea of phasing in an increase to the RMDs as high as 75 years old. And so that's already something where they're looking to change Secure Act 1.0, which we just got. So it's kind of interesting. Another kind of example of that is when I mentioned that there is now eligibility for long-term part-time workers. The Secure Act 1.0, if you will, actually said that if they were a long-term part-time worker for at least 3 years, then you would have to offer them coverage. And Secure Act 2.0 would change that to 2 years. And so we see some things that are thrown in here that are going to make it easier for people to access their retirement. And we've included a link to the summary of the new bill here. And so just keep in mind that that's coming up. We're not sure when it will pass, but it will likely pass in some iteration. So next slide, Diane. I'm going to take y'all out just with a conversation about business as usual. We spent this whole day talking about a lot of the newer things that are in place and are going to be in place. And these are things definitely that you all are contending with and trying to figure out how to navigate. However, there's also just the regular compliance requirements, right? And so I wanted to make sure to mention those because, although I think all of our worlds got upended by COVID-19, there were a lot of aspects of benefits compliance that are the same, right? Like you still are going to have Form 5500 filings done this year, if you're a calendar year plan by July 31st, or you're going to have to request an extension. The PCOR payments and filings are still coming due. In October or by October. Medicare creditable coverage notice requirements are going to be coming up. And these are just kind of the three that I throw out here. But keep in mind that the whole year's worth of benefits compliance is still ongoing. And we also have benefits compliance calendars that our team has created, so if you're a client on the call who is interested in kind of just knowing what the requirements are each month of the year, then that's something that you can ask your advisor for. I'll also point out that just from the standpoint of someone who's kind of a prior regulator, that, the IRS and the DOL have ramped up kind of their enforcement because obviously last year, a lot of them were working from home, kind of like we were, and their, ability to do that kind of with government systems and being from home kind of really put them in flux, and they're kind of back at it. Right. For example, we know with the IRS, the employer mandate and reporting enforcement has already begun. We have a lot of clients who are receiving Forms 226J letters just saying, hey, you said that you didn't offer coverage to 95% of your employees and basically, indicating that you could be subject to a penalty. And so keep in mind that they are out there, right? And DOL audits, went to desk audits last year just because like most of you, they were not getting out. But, we might even see some in-person visits resume, when they are able to do that safely. And so, they're definitely going to be ramping up enforcement. And then also, the last thing I wanted to mention is that, we're in a highly litigious time, Everyone's filing lawsuits. We get a lot of questions as of recently having to do with, for example, coverage of gender dysphoria, to shout out some of the people we've been working with and things like that. And I just like to bring this up because, although we often think of the IRS and DOL and government agencies as the boogeyman, I think we are entering a new phase where people are more, let's say, educated on kind of what their rights are under the plan. And it's more likely that they might choose to sue you if they have kind of a problem with what's being done. And so that is kind of our presentation for today. I know it's right at time. Carol, was there anything that you saw that you feel like we just have to address?
No, I think we did a good job. It was a very good overview, and I don't see any outstanding questions. So I thank everybody for joining us today.
All right, Leanne, you're going to kick us out?
You've got it. All right. Thank you so much, Beth and Diane and Carol, for sharing your valuable time and your expertise with us today. To reiterate, today's presentation has been recorded. We will be sharing the recording in the Get Wise Wednesdays emails, along with sharing them on the NFP website. If there are any portions of this call that you have missed, by no later than Friday, you will receive an email with a link to the full recording. The PowerPoint slides used during today's presentation will be shared in that same email. Lastly, for those of you that may have joined the call a little bit later and who are certified with your PHR, your SPHR, or your GPHR, this webinar has been pre-approved for a 1-hour recertification credit. In the next 24 hours, I will email the program ID number for you to record and submit to the HR Certification Institute. This credit will only be available to those who have listened to the actual webinar and not listening to the recording later. Additionally, you must remain on the call for the entirety of the webinar to be eligible for this credit. At the end of the call, a survey will populate in a new window. Please take a brief moment to complete the survey as it lets us know what topics are important to our listeners and helps us to make our education program as current and relevant as possible. That concludes the webinar for today. Thank you all so much for joining us and have a great day.